Imagine living in a world where money didn't exist. No coins, no bills, no digital transfers. Instead, you traded what you had, a basket of barley for a new pair of shoes. But what happens when you need something no one around you can provide, or when trust in your trade partner isn't guaranteed? This exact challenge forced ancient societies to invent something revolutionary: money. From shells to gold coins, and now cryptocurrency, money has evolved alongside humanity. But how did these changes shape power, economies, and even nations? Today, we'll take a journey through the history of money, exploring its origins, transformations, and the pivotal moments that shaped our financial systems. From its humble beginnings as bartering tools to the rise of digital currencies, the story of money reveals how humans solved problems, gained power, and built the foundations of the modern world. Barter to tokens, the dawn of money. Before money existed, people lived in small, tightly knit communities where they relied on bartering to exchange goods and services. Farmers traded crops for tools, while artisans exchanged their crafts for food. To maintain fairness, informal records of debts were kept in memory, ensuring that everyone contributed and received their share. This system of reciprocal exchange worked well in small groups, where trust was strong and transactions were simple. However, as communities grew and trade networks expanded, managing exchanges became increasingly complex. Tracking who owed what became a challenge, especially when taxes were introduced by rulers, adding another layer of difficulty. Early attempts to solve this issue included IOU notes, but these were only as reliable as the trust placed in the issuer. To simplify trade, people started using tokens like whale teeth as physical stand-ins for IOUs. These objects represented value, enabling individuals to trade with anyone, even strangers, without direct trust. They also allowed people to store purchasing power for future use. In creating these tokens, humanity not only invented money, but also the concept of debt, a system that continues to shape economies today. Coins of power, the rise of metal money. When people started using various items as money, like shells, barley, or feathers, they noticed certain limitations. Barley, for instance, was heavy and perishable. Whale teeth were difficult to divide, and shells weren't scarce since they could be collected easily. Feathers, lacking intrinsic value, weren't practical for trade outside small communities. Recognizing these flaws, kings began minting coins from precious metals, stamping them with symbols to guarantee their value and weight. Metal money was portable, durable, divisible, and scarce, checking all the boxes for effective currency. Plus, its intrinsic value made it useful for trading with other regions. However, the success of metal money brought temptation. Sovereigns often debased their coins by reducing the precious metal content or mixing in cheaper materials to produce more currency than their reserves allowed. Lightweight wealth, the invention of paper money. Carrying large amounts of metal coins was both cumbersome and impractical, especially as economies grew and trade expanded. To solve this, Chinese rulers developed an ingenious solution. They stored coins in secure locations and issued paper IOUs for trade. These certificates, though lacking intrinsic value, gained acceptance because they could be redeemed for tangible assets like coins or precious metals. This marked the early evolution of paper money, transforming commerce by offering a lightweight, convenient alternative to metal currency. As global trade routes expanded, the concept of paper money spread across the world. However, traders and lenders raised concerns about the ease with which paper money could be overproduced, potentially leading to inflation. To address these fears, governments tied the value of paper currency to gold, creating a gold standard to stabilize exchange rates. Despite several efforts to maintain this system, the growing need for flexible economic policies led most countries to abandon the gold standard by the 1970s. Today, the value of a banknote depends entirely on collective trust and confidence in the issuing government. Stones and notes, early banking systems. On the Pacific island of Yap, currency took the form of enormous stone discs called rye stones. These massive stones were so large and heavy that they were rarely moved. Instead, ownership was tracked through verbal agreements and community consensus. This innovative system functioned as a precursor to modern promissory notes and early banking practices, allowing wealth to change hands without the physical transfer of the currency itself. When the island's chiefs began accepting these promissory notes instead of the actual rye stones for tax payments, they effectively relinquished control over the money supply. This shift highlighted a critical issue that remains relevant today: the difficulty of regulating money. By the 20th century, economists recognized the importance of controlling the amount of money in circulation to ensure economic stability. However, private lenders, who create the majority of money through loans, made this task increasingly complex. The hidden cost of wealth, money, and inflation. In the 16th century, Spain returned from its colonies with vast amounts of precious metals, primarily gold and silver. Initially, this wealth influx seemed like a windfall, promising economic prosperity. However, the sudden increase in available money caused traders to raise prices, diminishing the purchasing power of gold and silver. This inflation disproportionately affected those without access to the new wealth, deepening economic inequality. Surprisingly, the only beneficiaries were debtors, as the value of their obligations shrank relative to the devalued currency. This phenomenon marked one of the earliest examples of inflation, driven by an oversupply of money, chasing a limited supply of goods. Inflation's impact could be tempered if traders increased production, or if people saved more, reducing the speed of money circulation. Yet achieving these conditions is often difficult, making inflation a persistent economic challenge. Dollars and independence, the rise of international money. In the 18th century, Britain imposed strict economic policies on its American colonies, requiring them to pay taxes in British pounds while prohibiting the colonies from printing their own currency. This forced the colonies into a dependency on Britain, as they had to trade extensively with the motherland just to acquire pounds. The policy placed a heavy economic burden on the colonies, with Benjamin Franklin famously attributing the American Revolution to these oppressive measures. After achieving independence, the newly formed United States introduced the dollar. Backed by the nation's extensive trade network and dependable tax base, the dollar grew to become the most widely used currency globally. Over time, many countries, including Britain, began storing significant reserves of dollars, solidifying U.S. economic influence on a global scale. Fractional reserve banking, building wealth on trust. By the 19th century, banking had evolved into a highly respected profession, integral to the functioning of modern economies. Banks earned profits by taking deposits from customers and lending that money at higher interest rates than they paid to depositors. Over time, they discovered an intriguing opportunity. As long as most depositors didn't withdraw their funds simultaneously, they could lend out far more money than they actually held in reserves. This innovative practice, known as fractional reserve banking, became a cornerstone of modern finance. It enabled significant financial expansion by allowing banks to create more credit, fueling economic growth and investment, but it also introduced risks of instability during times of financial stress. Future money. What's next? Cryptocurrencies like Bitcoin are revolutionizing the way we perceive money, introducing a decentralized digital form of currency that operates outside traditional banking systems. Unlike physical money, Bitcoin is secure, transparent, and operates on blockchain technology, making transactions faster and borderless. But could this innovation be the ultimate disruption to traditional financial systems? Or is it merely another step in money's ongoing evolution? As governments grapple with regulation and banks explore digital alternatives, the future of money hangs in the balance. Will cryptocurrencies democratize wealth, reduce inequality, and empower individuals? Or will they create new challenges, such as volatility and environmental impact? One thing is clear: Bitcoin and its peers are reshaping the financial world in unprecedented ways. From bartering goods to the rise of digital currencies, the history of money is a story of trust, innovation, and power. It shaped civilizations, sparked revolutions, and redefined how we value the world around us. But as cryptocurrencies challenge the status quo and physical cash fades into history, what's next for money? Will digital currencies truly democratize wealth, or will they create new forms of inequality? Can trust survive when currency becomes purely virtual? If you found this journey through money's history intriguing, don't forget to like, comment, subscribe, and hit the bell icon so you never miss an update.